Listen to me very carefully. If you look at your family's bank statements over the last 5 years, you will find three specific companies that have been quietly, ruthlessly draining money out of your accounts, month after month.
And the crazy part is, it's not even stuff you can just cut back on. It's not like skipping a latte. It's the invisible bills, the software you literally need for your kid's school, the food you buy to stay healthy, the materials that built the roof over our heads.
Exactly. But look, here is the mental shift we had to make, and it's what we want to talk about today. Instead of getting angry at how expensive life is getting, you have to ask yourself, how do I stop being just the consumer and start becoming the owner? If these companies are going to take our money anyway, we might as well own the toll booth.
Which is the perfect way to kick this off. I'm Lynn.
And I'm Frank. Welcome to Talk and Wonder. We create easy-to-understand whiteboard animations covering family finance, investing, and how to build a real financial moat around your household.
Our goal is to break down complex financial topics, help you avoid traps, and build wealth together. If you want to secure your future, you are exactly in the right place. Oh, and quick disclaimer before Frank gets too excited, we are not financial advisors. We're sharing our personal framework. Please do your own homework before buying any stock.
Right. So, let's talk about the first wealth drainer, the digital toll booth, Adobe.
The Adobe tax.
The Adobe tax, exactly. Now, guys, if you've ever edited a photo, or if you've signed a PDF on your computer, or even watched a professionally edited video on YouTube, there is a massive chance Adobe software was involved. Photoshop, Premiere Pro, Acrobat.
Yeah, but here's my issue with them, and I think this is what makes everyone so mad. You used to just buy a software. Like, I remember buying a CD-ROM in a box, installing it, and that was it. I owned it forever.
Yes, and that right there is the exact reason why Adobe is such a powerful business today. You nailed it. Back in the day, you bought the CD, you installed it, and if Adobe wanted more money from you, they had to convince you to go back to the store 3 years later to buy the new CD for version 2.0.
Which nobody did unless they really had to.
Right, but then they switched to software as a service, SaaS, the Creative Cloud. They said, we're not selling you the CD anymore, we are charging you a monthly subscription.
Which means the money never stops leaving our account.
But as an investor, and that is exactly what you want. Think about it. During that monthly subscription, the user gets constant updates. They don't have to worry about what's new out there. But for the business, it creates what we call a sticky ecosystem.
Sticky is an understatement. If you're a graphic designer or a video editor, your entire workflow is built around Adobe. Your files, your team's files, all your shortcuts. If you try to switch to a cheaper software to save, I don't know, $30 a month,
It's a massive headache. You lose productivity. You probably lose clients. So what do most people do? They just keep on paying every single month.
okay, I get the business model. It's a trap, but it's a very profitable trap. But wait, didn't their stock absolutely tank recently? Like, isn't everyone saying AI is going to kill Photoshop?
And that is where the opportunity is, because Wall Street is completely misunderstanding what Adobe is actually doing with AI. So the whole market is panicking. The stock is down like well over 50% from its highs because of this exact fear you just mentioned. People think some random AI generator is just gonna poof, make Photoshop irrelevant.
Right, because if I can just type, show me a picture of a golden retriever in a spacesuit, and it pops up in 5 seconds, why do I need a professional editing software?
It's a fair question, and honestly, it reminds me a lot of Microsoft back in 2012.
Oh, when everyone was convinced Apple and smartphones were going to rip Microsoft out of business?
Exactly. People were telling me Microsoft was a dead company, and I kept looking at their numbers going, then why does their revenue keep going up if they're so dead? Adobe is in the exact same spot. They didn't just sit there and let AI roll over them. They built their own AI engine, it's called Firefly, and they baked it directly into Photoshop.
So they are basically adopting the threat.
Right, they're using AI to make their products more powerful, not obsolete. But Lynn, look, let's ignore the AI story for a second. The story is just noise. Let's look at the actual math, because the math alone should shock you.
Okay, hit me.
Last year, this dying company generated $103 billion.
Wait, what? 103 billion?
And wait, let me be clear, that's in free cash flow, not just top-line revenue where you still have to pay expenses. This is the cash left over.
Frank, stop. Wait, are you serious right now? 103 billion in free cash flow?
Yes, and their enterprise value, if you account for the difference between their market cap and enterprise value, which is essentially their debt is only around 11 billion.
So, wait, let me do the math. They could literally pay off their entire corporate debt.
In a little over a month of just running their business.
Okay, wow, that is not a dying company. That is a machine.
It is a machine. Over the last 5 years, they've consistently done about $8 billion a year in free cash flow, and it just keeps growing. And because everyone is so freaked out about AI, the stock price is broken, but the business hasn't.
I like that. The price broke, not the business.
Exactly. Right now, it's trading at roughly 10 times free cash flow. If it drops any further, it's going to be in the single digits.
Okay, pause. Time out for the non-finance majors here. When you say trading at 10 times free cash flow, what does that actually mean for our family's money?
Okay, let's use real estate. We understand real estate. Imagine you buy a rental house in our neighborhood, and the rent you collect from it, pure profit after you pay the taxes, the maintenance, everything, is so high that it pays off the entire purchase price of the house in just 10 years.
I would buy that house in a heartbeat.
We all would. And here's the kicker. This isn't just a normal house. This is a house where the tenant has a 90% gross profit margin, and they can never move out because their entire career depends on the house.
Okay, now it sounds like an illegal monopoly.
Right? But you're buying a massive, high-moat, growing business at 10 times earnings. Meanwhile, companies like Microsoft or Google are trading at 8 to 10 times their sales, not even their profit. The premium is insane over there, and Adobe is just sitting here cheap.
Because people are letting the AI headlines scare them away from the math.
Precisely. But Adobe is just one side of the coin. It's the digital side. What if I told you there's a company doing the exact same thing, extracting insane profit margins from a very loyal, trapped customer base, but they're doing it with groceries?
Groceries? You mean the industry where tomatoes go bad and they make like a penny on every dollar?
Usually, yes, but not this one. This one specifically targets people who turn the package around to read the ingredient labels.
Okay, people who turn the package around to read the ingredient labels. You are 100% talking about Sprouts Farmers Market, aren't you? Because I am literally that person.
Yes, I am. Ticker symbol SFM. And look, since you're the one who actually manages the grocery budget, what makes it different from, say, a Kroger or a Publix? Because to me, a grocery store is a grocery store.
Oh, it's completely different. Well, first of all, they refuse to sell Coke Zero, which still annoys me.
Right, the absolute tragedy.
It is, but honestly, it's just smaller. It's not this overwhelming fluorescent-lit warehouse. It's focused. It's fresh produce, organic meats, natural snacks, and like aisles of vitamins. If you care about what you put in your body, once you find a store that matches your values, you just you don't go back to a regular store.
And that right there, that exact psychological loyalty is why it is one of the best retail investments I've ever seen. Look, like you said earlier, most grocery stores are terrible businesses. It's a brutal, brutal industry. They grow maybe 1 or 2% a year if they're lucky, and their net profit margins are razor thin, like 1 or 2 pennies on the dollar.
Yeah, because tomatoes spoil and milk goes bad. It's high waste.
Exactly. But Sprouts, their net profit margin is 5.7%.
Wait, for a grocery store? That's actually huge. How are they doing that? Is the organic stuff really marked up that much? Or is it just a health tax?
It's not just the organic stuff, it's their organic stuff. Look at the Sprouts branded items you buy. Their gross profit on normal items, meaning, the profit before overhead, is around 39%, which is already great. But on the Sprouts private label brands, it's like 60 to 70%.
Oh my God!
What?
So when I buy the Sprouts brand almond butter thinking I'm being smart and saving money over the name brand, I'm actually giving them their absolute highest profit margin.
You are single-handedly funding the shareholders, honey. You are the moat.
I feel so manipulated right now.
don't. It's a win-win. You get good food, they make money. And as they push more of their private label, I think their overall margins could easily hit 6 to 8%. But here is where it gets really interesting and honestly a little painful for me to talk about.
Oh, are we getting a frank confession time?
Yeah, so I have a history with this stock. I actually bought Sprouts a while back when it was trading in the low to mid 30s.
Okay, nice. Good job. $30 sounds cheap.
Well, wait, the stock started running. It went all the way up, and I was doing this thing called covered calls, basically an option strategy where you cap your upside, and I ended up having my shares taken away from me at $165.
Wait, hold on. You bought in the 30s and sold at 165? Frank, that is a massive win. Why do you sound so depressed?
Because right after I lost my shares, it kept driving higher. It went up to like 182. I remember sitting there at my desk thinking, oh crap, did I just miss out on the rest of the run? I felt like such an idiot.
Which is exactly the FOMO trap.
Exactly. I had to step back and use the process. I looked at the numbers and realized, no, the stock was just getting ahead of itself. It wasn't worth anywhere close to $180 at that time. So I just waited.
So you didn't buy back in at the top?
No, and I got lucky. The stock eventually pulled back significantly. But here is the most crucial part of this entire story, Speaker One. The stock price fell, but the actual business did not fall apart. They kept posting industry-leading results.
Okay, I love this concept. The price got cheaper, but the business got better.
Yes, that is the dream setup for an investor. They only have about 400 to 500 stores right now. Their long-term goal is to get to 1,200 or 1,400 stores. And every time they open a new store, the return on that capital is incredible. They're literally taking the cash they make from your almond butter
And using it to open more stores that print more cash.
Exactly. But they aren't just opening stores, they're also buying back their own stock, which brings us to the actual valuation. How do we know what price is actually safe to pay?
Okay, so how do you figure out the safe price? Because right now, to me, $79 a share sounds high if you originally bought it at 30.
Well, that's exactly why we don't just guess based on past prices. We use the stock analyzer tool. And you know me, I never look at just one scenario. I always build a low, a middle, and a high assumption for the next 10 years.
The what if the world ends versus the what if everything goes perfectly scenario.
Exactly. So for their revenue growth, I'm being pretty conservative here. I put 5, 6, and 7% a year for the next decade, even though they've historically grown faster.
Better to be safe than sorry. What about profit margins?
For profit margin, I did 5.5, 6.5, and 7.5%. Remember, they are pushing those private label brands you love so much, so I expect the margins to creep up. And finally, I'm demanding a 9% annualized return on my money.
Meaning if the stock doesn't at least give you 9% a year, it's not worth the risk of being out of an index fund.
Bingo. So, I hit the Analyze button, and based on my middle-of-the-road assumptions, the fair value is around $135 a share.
Okay, wait, the stock is currently at 79 and your middle assumption says it's worth $135.
Right, and even my low-end, absolute worst-case scenario price is $86, which is still higher than it's trading at today.
So there's a lot of meat left on that bone.
A massive amount. It's showing a potential 16% annualized return. And look, the management team agrees. They are aggressively buying back their own stock right now, which is exactly what you want to see when a stock is undervalued. Good capital allocation.
Okay, I get it. We're basically buying the toll booth on people trying to eat healthy. But what about the third company? Because you mentioned earlier it has something to do with housing. And right now, nobody can afford to buy a house.
Which is exactly the problem. The United States currently has a housing shortage of roughly 4 million homes. 4 million.
Right, because interest rates are so high, nobody wants to sell their current house and lose their low mortgage rate.
Exactly. It's called the lock-in effect. People are stuck in their homes. But here's the thing. The demand for housing hasn't disappeared. It's just pent up. Those 4 million homes still need to be built. And when a construction company finally gets to build a neighborhood, they have to buy their materials from someone.
Lumber, windows, doors.
All of it. And that brings us to stock number 3, Builders First Source, ticker symbol BLDR.
Okay, I've definitely seen their trucks.
You have. I remember when I first really started digging into this company, I would drive past these new housing developments, and instead of just looking at the house, I started looking inside the half-built garages, and I kept seeing the Builders First Source logo stamped on the wall frames, the lumber, everything.
So they're basically the ultimate middleman for home builders.
They're the market leader, but they didn't just stop at selling lumber. Because lumber prices, they go up and down like crazy. It's a volatile commodity. So what Builders First Source did, especially after the great financial crisis, is they started buying up their competitors, ProBuild in 2015, BMC in 2021.
So they bought the competition to control the market.
Yes, but more importantly, they evolved. They don't just drop off a pile of wood anymore. They actually pre-cut and pre-assemble parts of the home before they arrive on the job site.
Oh, that's smart. That saves the builder time and labor costs on site.
Exactly. It makes them far more valuable and way harder to replace. It shifted their business from just a low-margin commodity supplier to a higher-margin, predictable service. And they're trading at an insane valuation right now.
Okay, define insane valuation, because everything you just said makes them sound like a premium company, which usually means an expensive stock.
That's the crazy part. Right now, Builders First Source is trading at roughly 3.5 to 4 times its normalized free cash flow.
Wait, 3.5? Didn't you just say Adobe is a steal at 10?
Yes, 3.5 it's absurd. The market is pricing this company as if no one is ever going to build a house in America ever again. Now, to be fair, their free cash flow did drop last year to around $860 million, which is lower than their 5-year average.
Because of the high interest rates freezing the housing market.
Exactly. But remember what we talked about. That demand isn't gone. Those 4 million missing homes didn't just vanish into thin air. It's pent-up demand. And you can't punish a company's long-term value just because of a temporary macroeconomic freeze.
Right. It's like judging an umbrella company during a drought. Eventually, it's going to rain.
That is a great analogy. Eventually, it will rain. And when it does, Builders First Source is sitting right in the middle of that wave. But honestly, Lynn, the valuation and the macro story isn't even my favorite part about this company.
Oh, what is it?
The management, specifically how they pay themselves.
Okay, you know I love corporate gossip. Spill.
So, usually, CEOs get paid based on top-line revenue growth or just arbitrary stock price targets, which means they can manipulate the numbers, like doing dumb acquisitions, just to get their bonuses.
And leave the shareholders holding the bag.
Exactly. But the management at Builders, their compensation is tied directly to profitability and returns on capital, meaning they only get paid big if they actually create real long-term wealth for the business. And get this, last year they missed their profitability target by just a tiny bit.
So they missed their bonus.
They did, but they could have easily fudged the numbers. They could have delayed some expenses, tweaked some accounting. CEOs do it all the time to hit that bonus threshold, but they didn't. They denied themselves their own bonus because they didn't hit the target.
Okay, wait. A CEO voluntarily giving up their bonus? That never happens.
Never. The chairman, Paul Levy, has been involved since 1993. He actually bought more of his own stock last year at $111 a share, increasing his personal position by 43%. And the company itself, they've bought back over 40% of all their outstanding shares since 2021.
40%? They literally bought back nearly half the company.
Yes, because they know exactly how undervalued it is. So when I sit down and run my analyzer tool for Builders, I have to account for that pent-up demand eventually coming out. I put revenue growth at 3, 6, and 9%. I put profit margins at 7, 8, and 9%.
And what did the numbers say? Because you said the current stock is around 75. Wait, didn't you say the chairman bought it at 111?
Yep. So right now, it's significantly cheaper than what the chairman paid. And based on my analyzer tool, my absolute lowest, worst-case scenario price for Builders is $145.
Wait, the current price is 75 and your worst case scenario is 145?
My middle price is $230.
Frank, that's a massive gap.
It is. But remember, Lynn, this isn't a get-rich-quick play. You have to be patient with this one. You're buying a company waiting for a housing freeze to thaw. If you're buying this, you have to be okay holding it for 10 or 20 years.
Which is exactly why you can't just treat the stock market like a casino.
Exactly. And look, I say this from experience. Almost 30 years ago, I was out there chasing hot stocks just like everybody else. I was following tips, listening to rumors, just hoping something would stick.
The whole get-rich-quick mentality.
Right, because I didn't realize that when I bought a stock, I was actually buying a piece of a business. I wasn't investing, I was gambling. And I was leaving so much real money on the table, money that could have been compounding, growing, and working for us around the clock while we slept.
Which is why we switched to a system, the 8 pillars.
Yes, you have to have a process. When you look at companies like Adobe collecting digital rent, or Sprouts building that high-margin grocery moat, or Builders FirstSource buying back 40% of their own shares, you don't just guess. You run the numbers. You check the free cash flow. You look at the return on capital.
You basically take the emotion out of it, because the news is always going to tell you to panic. AI is destroying software, or interest rates are killing housing.
Exactly. The headlines want you to panic, but the math just wants to compound. And that's exactly why I built the 8 Pillars framework. It's to help people who are sick of guessing, sick of not having a process, to finally feel, well, warm and fuzzy at night, knowing exactly what they own.
And not panicking when the market drops 5% on a Tuesday.
Exactly. This is the moment where casual investors stay broke and serious investors pull ahead. Because if I can find, 30 or 40 companies that look like these 3 and just hold them for a decade, the math does the heavy lifting for you.
But you have to be willing to actually look at the math first.
Right, which ironically is what most people refuse to do. They'd rather just buy whatever the loudest person on the internet is yelling about. Speaking of which, you know that other list we made? The one looking at the so-called Magnificent 7 tech stocks?
Oh, God, yeah, that list.
Because everyone thinks those 7 are the only safe place to put money right now. But when you actually run the free cash flow numbers on some of them,
The math gets really, really ugly.
it gets terrifying. In fact, if you put them side by side with the 7 companies I actually think will beat them over the next decade, well, the results are